Hello, everybody. If you want to understand where the 2026 housing market is headed, you cannot just focus on housing. You must start with other economic factors like the bond market, like inflation, and of course the labor force. Because interest rates are not emotional, they are mechanical. Hello, my name is Christian Penner, and I've been in the mortgage and real estate business since 1997, and I have seen all kinds of real estate markets. I've navigated through the dot-com cycle, the housing boom, the housing crash, QE, quantitative easing, the tightening cycles, the pandemic stimulus, where interest rates were significantly lower than they are today, and now we just went through the fastest rate hike in modern history. And one thing never changes: structure drives outcome. Leading bond market forecasters like Barry Habib, who you're going to see here shortly, analyzes housing through the relationships between a 10-year treasury, inflation, employment data, and mortgage market spreads. That is the lens. In 2025, that lens, we forecasted the 10-year treasury to be at 3.8%. It hit 3.89%. Unemployment rising towards 4.5%. It closed at 4.56%. Spread comparisons and mortgages had happened. And now let's talk 2026. Inflation is moderating beneath the surface. Shelter data is lagging reality. Labor markets are weakening more than the headline number suggests. If unemployment trends towards 4.8% and inflation drifts towards 2.5%, the Fed has room to cut. If the 10-year treasury moves towards 3.8% and the spreads normalize to 1.9%, the 30-year mortgage interest rate will probably be testing the 5% range, and that becomes mathematically possible. What does that mean for you? It means an opportunity to refinance. So it also, if you're a buyer in this market, it's going to unravel the inventory opportunities for you, and housing prices may substantially start moving higher as interest rates drop. So I want you to be aware of that situation if you're a buyer. And if you're a homeowner and you're looking to refinance, we should put you on our interest rate monitoring platform. Well, it will alert you on strike rates as the rate comes within your timeline of where you want to be from a payment perspective from where you are today. So if you're interested in that, drop a line to us here. Either send me a DM. You can also schedule a time with us on our calendar at ams.money/calendar. You can also call us directly at 561-316-2002 and watch the video that I'm about to play here from Barry Habib that goes in depth of what's going to happen in the 2026 housing market. And if any of this resonates with you and you want to connect with us on a different level and get that Rate Watch report and have a home buy report also for free that navigates through the sales in your local area, it shows you what your equity buildup has been over time, how much principal you've paid down, what are the valuations of the properties around you, and how does your interest rate that you have compare to the current markets today. So it's a report on a monthly basis that gives you all that data to make an educated decision with us. So if you're interested in any of that, call us to set up a time to get enrolled in any of those programs, to set up your strike rate. And also, if you're a buyer in this market and you want to navigate through it successfully with a pre-approval, not only just on paper, but through the underwriting, which will actually give you a better offer, a stronger offer, if there's a competing offer in place, because we actually underwrite you instead of just giving you a pre-approval letter. So if you're interested in any of that, if you're a homeowner looking to refinance down the road, or you need to refinance today, we are doing a lot of equity lines for our clients because their interest rates are so low and we're consolidating some debts and stuff like that. So if you need that today as a Band-Aid, waiting for interest rates to come down, we can help you with that as well. So listen, I look forward to talking with you. If you have any questions at all, shoot me a DM, send us an email at team, T-E-A-M, at ams.money. That's T-E-A-M at ams.money. Or like I said, shoot me a DM here or call us to set up an appointment or schedule it at ams.money/calendar. calendar. I look forward to talking with you. Have an awesome, amazing day.
Well, it's that time again. Time to look into the crystal ball and see what the future might hold, this time for 2026. Seems like the years just fly by faster and faster each time around. And that puts pressure on us to try and look into the future and see where might we be for economic conditions? How would that affect the housing market? What's going to happen with home prices? And the big driver, of course, it's very sensitive to all of us, is interest rates. But even more importantly is to try and understand where there's an opportunity for our clients to purchase a home or what they could do with the home that they have. So let's take a peek into the future and look at the forecast for 2026 from MBS Highway. I'm going to show you some charts here and go through this step by step with you. And while we might wind up trying to find out what happens to the housing market, a lot of that has to do with what happens to interest rates. But to find out what happens with interest rates, we're going to have to take a look at what's going to drive interest rates. Let's take it step by step. But first, let's take a peek at how did we do last year. While we don't get everything right, of course, nobody does, I'm pretty proud of our 2025 forecast. So we shared this with you. And our 2025 forecast, we looked at the 10-year Treasury, and we thought that the 10-year Treasury would hit a low of 3.8%. The actual low was 3.89. I'm going to say that's pretty darn close because when it started the year up about 1% higher than that, forecasting for it to come down that much was a pretty bold move, and we were kind of out on an island on that one. But I'm going to say that this was a pretty good forecast as far as 30-year fixed rate mortgages. We did forecast a low target of range of 5.75% to 6%. And you know what? We came within a hair of that as well. At 6.1 was the low that we are experiencing at the end of 2025 here. So I think both of these were pretty reasonably good targets to hit, especially when you consider that mortgage rates were much higher, around 7%. So forecasting these low levels and coming in pretty darn close to it, we're going to consider that to be a pretty good one. Now, the spread on the rate of a 30-year fixed rate mortgage above the 10-year Treasury, we started the year somewhere about 2.8%, and we did say it would come down to 2.25%. And again, pretty bold move to see that big of a difference in the Treasury spread. But you know what? Actual 2.2%, that's pretty darn close to a bullseye, isn't it? We had forecast 3.5% for home price appreciation. And the actual, now a lot of these numbers are coming in, but they're delayed several months. But the more recent data that we got from Redfin shows that home price appreciation on a national level, 2.6%. So we're a little bit optimistic here, and that kind of coincides because perhaps if rates were just a smidge lower, we might have gotten a bit more appreciation. And again, this is a national level. Some areas, much sharper appreciation. Some levels were much lower than these numbers. This is a national number that we go by. Obviously, you are going to be in a specific market, which is going to have its own specifics, but this just gives you an idea on the national average. Unemployment, a very big driver. Now, we had said that we had thought the unemployment rate would go to 4.5%. That was quite the call because many people were thinking, most Fed members were thinking, 4.2% or so, and most economists also in that range. We forecast 4.5%. We were kind of an outlier there, but guess what? The actual was 4.55. So once again, the recap, we're pretty pleased with our results. You're never going to get everything correct, but boy, we were either very, very close or very much on target in just about every area. So let's see how we do this year. As we go through the 2026 forecast, let's start with inflation. I think this is a very important one because inflation does drive the bond market to a pretty big extent, and it also is an important factor for Fed members as they weigh what they should do with cuts. So we see that as we look at the Fed's favorite measure of inflation, headline personal consumption expenditure was 2.8%, but the core was also 2.8%. And that's really what the Fed focuses on. We know that they want their target to be 2%, but we also know that this number is really overstated, right? And the reason why it's overstated is because shelter is very delayed. Now, look, shelter, the BLS and the BEA, they measure these things, but they only look at a small portion of the country every month, 1/6 of the country. That means the other 5/6 of the country, 83%, it is not being looked at, so you're not getting up-to-date information. Now, when we look at real-time information, things like apartment list and totality and the numbers from Fannie Mae and the information that we get from things like Zillow, it shows rents continuing to decline. But just this also hasn't been caught up in the numbers that are being reflected. And let's also remember that when they look at rents and they say, okay, how much are you paying rent? It could be reflective of a lease that was signed many months prior to that. So again, big delay here. But look at the chart. It's starting to trend in our direction. We can see this moving lower, lower, lower. And you can see what happened here. Rents were going up, up, up very rapidly in 21 and 22. But the reason why the Fed kept the printing press going and rates at zero was because while this was going up and we knew that inflation was to follow, the Fed didn't pay attention to this. And this time, let's hope the Fed pays attention to this and sees that this number of inflation will likely come down slowly, but it will likely come down, and that this number is overstated. Other things that are overstating inflation are things like the tariffs, which should start to kind of come off of that as we head into the middle of 2026 as well. So we see these numbers coming down. And as I mentioned, shelter is the biggest weighting, but it's also even more of a large weighting in the consumer price index. And the consumer price index, which shows that headline inflation is 2.7 and core is 2.6. Boy, look at the weighting on shelter. It makes up more than a third of the core. More than the third of the headline. And boy, almost half of the core weighting on the CPI level. So it's so important, and it is heading lower. And I think this will be a big help for us in the mortgage industry. As far as real estate prices go, too, it'll be a big help because this should be an important tailwind for us in helping us to see lower inflation, which will make it easier for the Fed to cut and easier for the bond market to feel comfortable with lower interest rates. So we think that core PCE inflation, while it's 2.8%, based upon overstatements, as I mentioned, for tariffs and also the lag in shelter, it's really much lower, although it'll take a little bit of while to get there. But then, portfolio management fees, we won't see this reflected in the lower numbers, but it truly is an overstatement. So if you said, okay, what's the real number? It's closer to like 1.9%, we think now. But we think that these things will start to come off and start to influence this number lower. So our 12-month forecast is that we get some of this. Maybe it could be a little lower than 2.5%, but we think we head in the direction of 2.5% on core PC. And, I think it's kind of a magic number. The Fed's target is 2%, but if we're below 2.5%, the Fed will start to feel a lot more comfortable on inflation and a lot more focused on the labor market, and that should help us to see lower interest rates. But also the bond market will start to feel more comfortable as well. And speaking of the labor market, let's take a quick look here. And look, I think I'm very proud of us, but because we called the weakness in the labor market certainly before any Fed member, and certainly before the vast majority of media outlets. So you've had that information and you knew it was coming. And so the metrics that we look at were very accurate in determining this weakness. And let's start with job openings. It has been trending lower and significantly lower over time. So job openings, that's a weak spot. And then it's hard to find a job once you're let go. And you could see that here. This is understated as well because unemployment claims and benefits, when you're on a continuing unemployment benefit, the state that you're in, it will vary, but most of them are around 26 weeks. So while more people might be coming on, people run out, and this only shows people receiving them. So it doesn't contemplate those running off of the benefits. I think that the amount of people that are unemployed and continuing to be unemployed is understated, even by this chart, which looks up. Now, a lot of people look at initial jobless claims, and it's an important indicator. But people are scratching their heads and they're saying, well, initial jobless claims, they're very low, they're very low, they're very low. And yeah, they're right. They are very low, but I don't think they're looking deeper. You have to look at this as chess and not checkers. So why are they so darn low if every other employment indicator is showing weakness? Why are we seeing initial claims so low? Is it true that people are holding on to their employees? Well, to some extent, I agree, yes. But I don't think that's the full picture. I think what we're also seeing is that if you analyze this, we have a gig economy. What do I mean by gig economy? Things like driving Uber and things of that nature. So why is that so important now? Well, because if you lose your job, let's say you go on unemployment benefits, the amount that you're receiving from unemployment benefits, if you claim them, if you choose to claim them, it may not be enough to pay your bills. So what do? You say, hey, unemployment benefits, I'm glad I get them, but I need more than that. if I'm going to pay my bills. So I have to do other things. And as you do other things and earn income, it'll either reduce or eliminate the amount you receive from unemployment benefits. So therefore, you may not file for unemployment benefits at all because it just simply doesn't cut it as far as making ends meet. And I think that's why you're seeing an understatement in the initial claims. It's not the whole picture, but it's part of the reason why it's so low. Now, this is a very important one, and this shows private payrolls. So private payrolls, look, do you see the chart, right? And the red line shows zero. So something we have not seen in a very long time is job losses. And look at 1 month, 2 months, 3 months, 4 months out of the past 6 that showed actual losses in jobs from ADP. And, we're looking at only 17,000, net job losses. We're not even seeing gains. We're seeing net job losses over the past 4 months. So this is a important indicator that shows we're heading in the wrong direction in the labor market. And so why would lower rates help? Well, lower rates means that it's easier to buy things because people buy with monthly payments. As that picks up, it helps pick up economic conditions and it requires more hiring. People will buy more, companies make more, pay employees more. So this is something that's important. And then the BLS job reports are finally starting to show some semblance of reality here. And you could see, first of all, look at the trend direction, and then look at this negative number, negative number, negative number. And then, of course, that the BLS has been overstating these numbers. So it's likely going to continue to be not only revised lower from the BLS, but also when the QCEW, the quarterly census of employment and wages, when they come up with the real numbers, it's going to show significant weakness. The most recent ones we have, and they're very old, so it's just up to the second quarter of 2025, it showed just a shocking number that essentially 3/4 of the jobs that were initially reported never happened. And if you take a look at from before the BLS did their revisions, it was almost 80% reading of inaccuracy. I'm not blaming the BLS; it's a Herculean effort based upon roughly 160 million people or so in the job market. It's very difficult to do and report on a monthly basis. But boy, 3 out of 4 or 4 out of 5 jobs that were initially reported never really happened. That should grab the Fed's attention, and it should require the Fed to move lower in interest rates once they understand that inflation is really not a big, item to be as fearful of as they are. Now, where should the unemployment rate go? So we were very accurate here. We said 4.5 for 2025, 4.55 was the number, but we see this trend continuing to, the 4.8% range. Who knows? It could get higher than that. If the Fed does not act and they let the job market deteriorate further, it would not surprise us to see it go even higher in 2026. So what does the Fed do? Let's first look at the composition of what's going to happen. The new Fed chair, look, we know this. We know Donald Trump will appoint this person. It'll be a dub that's going to happen in May. And that will be someone that'll be in the dovish camp. We know the voting member of New York always votes, John Williams, mildly dovish, not amazingly dovish. Governors who always vote, Michelle Bowman and Christopher Waller, they will be dovish as well. And Anna Paulson, who's the Philadelphia Fed president, she will be voting this year. And she has given us indications that she will be dovish. Now, Michael Barr and Philip Jefferson, they're governors, so they always vote. And Neil Kashkari, who's a voting member this year, one of the people that rotate in from the 12 presidents, they rotate in for, New York always votes, and the remaining 11, 4 will be selected to be voters, and Neil Kashkari is rotated to be one of the voters this year. A centrist, as is Michael Barr and Philip Jefferson. And then people that have indicated a more hawkish stance is Lisa Cook. She's a governor, so she's always going to vote. And Beth Hammack and Lori Logan from Cleveland and Dallas, respectively. They have made, especially Beth Hammack, very significant indications that they will be hawkish. I disagree with so much that Beth Hammack says, and I don't think that she is looking at things rationally or responsibly on the inflation front, and she's ignoring the weakness in the labor market. I think she's being very irresponsible in her comments, but we'll see what happens. If the evidence becomes irrefutable, these people may come around. We're looking for the Fed to cut rates, if they're quarter point increments, 3 times, 2.875. Again, we're an outlier here. Most people are looking for one cut in 2026. We see three, and that's basically because we think the labor market is weaker than most people think, and we also think inflation is overstated and not as bad as most people think. So if we're right, we probably will see a 2.875 Fed funds rate. Who knows, maybe less, and that should help mortgage rates. So mortgage rates for this year, factors that will be important in understanding where mortgage rates are going. We're going to see additional indebtedness by the U.S. government. And that additional debt is going to lead to more bonds and more supply. So this is a negative one for us. But we can take that debt and term it shorter. So instead of having more debt and meaning more 10-year treasuries being issued, which would hurt mortgage rates and the longer end of the bond market, we could see Treasury Secretary Bessent say, let's not issue more longer term debt, let's issue more shorter term debt. And I think that would be still getting that amount of dollars that the government needs to be funded and match the outlays by borrowing it. It won't affect the longer end of the curve and things like mortgage rates as badly. Another thing that we have to consider is bank deregulation. So bank deregulation will make it easier for banks to be able to buy treasuries, because right now when the bank makes a purchase of treasuries or any kind of a bond or lends out money, they're limited in the amount that they could do so relative to the amount of capital that they have. So as they bring deposits in, they can't just willy-nilly say, hey, we want to bring in unlimited deposits and lend out that money and make the difference between that, called arbitrage, which is profitable. They're limited. They're limited because you have to protect the depositors. So they have to withhold a portion of the amount that they're holding that they get from deposits as security. But what Scott Bessent is saying is that, it's really a risk-free asset when you're buying treasuries. So why don't we allow that to be unlimited and don't limit it to a percentage of the amount of capital that they have? And that makes it easier for banks to do so. And the reason why he's saying that it shouldn't be encumbered is because it's a risk-free asset in buying treasuries, because it's backed by the full faith and credit of the U.S. government. And going back to terming debt shorter, the Genius Act will absorb this debt because the Genius Act, if you're unfamiliar with it, is allowing now for stable coins, and stable coins have to be backed by shorter term debt. As stable coins grow, and it is growing, that means more and more short term debt would have to be purchased in the way of treasuries to be able to back that, back the stable coins. So this Genius Act will help with terming debt shorter, giving you more absorption. And then, of course, there's quantitative easing by the Fed. And they have started in December of 2024. We don't know how long it's going to last, but buying $40 billion of short-term debt. Now, that short-term debt, again, goes hand in hand with terming debt shorter. So we see all these factors, most of them pretty positive, helping with mortgage rates. Now, let's start with the 10-year Treasury, because the 10-year Treasury will be an important factor. And what are our targets for the 10-year Treasury? Last year, our target was 3.8. We came up a little bit short at 3.89, but we think that we could hit 3.8, 3.7, and 3.6 are the levels that we see. But I think 3.7 makes a lot of sense to us. There is some technical factors, I think, and when you combine them with the fundamental factors, we like 3.7 as a target for a low in the 10-year Treasury. Now, what does that do for what does that do for us for the spread between the 10-year Treasury and 30-year fixed rate mortgages? So while as we record this, we're at 2.2% at the end of the year, we did hit 2.12, and we did see we starting the year at 2.6. So we did move down quite a bit, but the natural range seems to be somewhere between 1.6 and 2%. So 30-year fixed rate mortgages should be somewhere between 1.6 and 2%. We're just a little bit above it now. As I said, as we're recording this, we're up to 2.2. It does fluctuate quite a bit, but I do think that we can get within this range somewhere. Let's say if we get somewhere in the middle of this range, that could be pretty good. So now we can do some math here. The 10-year treasury we like, somewhere around 3.7. But if we get to 3.8% and, the spread narrowed, I know we said between 1.6 and 2. So, 1.8 would be in the middle, but let's be a little more conservative here and say we get to 1.9. I think these are realistic levels that we could hit. That would be a 5.7% mortgage rate on 30-year fixed. But, if we got to 3.7 here and we got to the middle range of 1.8, it wouldn't shock us to get to 5.5%, based upon that. But being a little conservative, our target's going to be 5.7. But again, if things go our way, we get to 3.7 as a low on the 10-year treasury, and the spread does narrow to the middle of the natural range between 1.6 and 2. That would give us 1.8, and 3.7 and 1.8 gets you down to 5.5%. So we will see. Let's give you everybody else's forecast here so you can compare. So we got the forecast from Fannie Mae, and I'm proud to say that this was at 6.4. I definitely had some influence here in them bringing this level down from 6.4 to 5.9. At being a board member, I had some discussions on the forecast there, and I gave some rationale that they apparently agreed with. National Association of Realtors and Bright MLS, Zillow, Wells Fargo, NAHB, Realtor.com, Redfin, and MBA, all above 6%. So you can see many people above 6. The average 6.17. We're down here at 5.7. So look, we're an outlier. And I'm comfortable with that. I'm comfortable being an outlier because we've been an outlier so many times. And of course, we don't always get them right. Listen, sometimes we're definitely on the wrong side, but much more often than not, we've gotten it right. And it's been great for us because we've won a lot of awards by being an outlier and getting it right. So I am comfortable not falling in line with the consensus and being here on an island and being the only ones really under 6%. Again, I had a big influence in this coming down from 6.4, folks, to the 5.9 level. So I'm comfortable with this. I have a lot of confidence in this, and I think that helps in a lot of ways. Why should it help you? Well, I think you should get excited about this chart. ICE and McDash did this here. And if you're looking at loans that have an 80 LTV, saving 0.75%, 720 FICO minimum, what would we be able to see in the amount of loans that are out there? And look, you've already seen a big uptick in refinances given the fact that we have seen lower mortgage rates. So if we're kind of right around here as we end the year with what's been done and what's available, take a look at what starts to happen if we get in the range of where we're thinking here. Lots of refinances. So a lot to look forward to for you on the refinance side. I think you should be planning for a good year ahead if our targets are met. But how about real estate itself? Real estate, look, we look at supply and demand. Demand's fallen off a cliff on household formations. It's just, but the other way to look at it is it's pent up demand because the historical levels are much higher. So what is this pent up demand going to be released by? Lower rates. So if we're going to see the lower rates that we have been forecasting, well, then some of this pent up demand gets released, and like a spring that's been coiled getting released, that comes on the market. And builders have cut back, as you see, and it's wisely so, because they've been trying to match the amount of demand that's out there. So they've been cutting back on supply, and builders will not be able to ramp up as quickly as supply can grow, and that equals an opportunity there. So we see there being some reasonable appreciation in real estate, especially since active listings, while they're higher, and people could say they're higher, look at them flattening out there. So there's been some absorption here. Towards the end of the year, we're seeing some growth in actual accelerated modest appreciation, and certainly accelerated pending home sales. So they're below past levels, but there's some signs here that there's good things ahead, and especially if rates decline. And while this has been moving up from extraordinary low levels, if we look at more normalized times like pre-pandemic here, we're still down 6% from when this was most recently measured in 2019. So I think that population has grown and inventory is still lower. So this does, again, every market's different. It does paint a picture that if rates do decline towards our targets, we should be telling our customers that there's pretty good opportunity in real estate. Now, let's give you everybody's forecast. We'll give you ours. First of all, look at the existing home sales increases here. A lot of optimism here to see a nice uptick and increase in existing home sales. Now, home prices, it does vary quite a bit. And we're at 3.5%. I believe that we could figure that this is a good number to pencil in. It's not too rosy. Again, these are national numbers, folks. So depending on where you are, where your market is, look at the numbers within MBS Highway because we do forecast for our zip code. And I think that you'll see what the outlook is for your marketplace. But on a national level, we're thinking that things should be pretty good. The only Cotality and the NAR are slightly above our estimates, but we are more optimistic than just about everybody else out there, folks. So let's review our forecast here. Unemployment rate rising to 4.8%, maybe higher. Core PCE inflation, we think around 2.5% feels about right to us. But again, this will be overstated. The real number is less than that, probably closer to 2. Let's hope the Fed understands that. And the Fed funds rate, because of a little bit lower inflation and the unemployment rate going up, we think they're going to need to cut 3 times, 3 quarterly increments. So if one's a 50 basis point, one will be 2 cuts. So 0.75% cut. If they come in 0.25%, there'll be 3 cuts, 2.875. And mortgage rate low, 5.7. But if things go the way we think they're going to go on the unemployment rate and inflation, we would not be surprised, especially if the spread comes in a little bit further, to see this even a bit lower than that, potentially to 5.5%, as we explained, and home price appreciation 3.5%. There you have it, folks. Those are our forecasts for 2026. The most important forecast that we hope comes true is that it's a great year for you. Of course, on the business side, but personally, health-wise, we wish you all the best. Thank you.